Hello and welcome back to Miss Finance. On today's episode, we're going to go ahead and have a look at the suitable procedures to gather audit evidence. Now, if you're currently undertaking any AAT studies, ACCA, CIMA, CIPFA, or any specific accounting qualification, then at some point you'll come across audits and gathering audit evidence. Now, auditors need to make sure that when they're gathering audit evidence that is both appropriate and sufficient. But when you're looking at this specific module, sometimes it can be quite difficult to know exactly where to start. So we're going to go ahead and jump into bank and cash. Now, if I was to look at bank and cash, I can break that down into internal controls, verification, examination, and reconciliation. Now, in the real world, if I was to go ahead and go to a client's premises, what I would be aiming for is to obtain third-party evidence where possible, because third-party evidence is the best form of evidence that you can obtain to back up a balance when you're looking at the likes of bank and cash. So first thing that I would do is I would ask the client to sign a request to their bank to receive a bank letter confirming the year-end bank balance. Now, if you can't obtain that, the next best thing would be a bank statement, because that is a form of third-party evidence, and that will confirm and validate the bank balance at the year end. Now, the next thing that I would be looking at is to verify the bank balance. And the way that I would go about doing that is I would obtain the bank reconciliation from the client, and I would go ahead and check those year-end balances back to the bank statement to verify that balance. And then I would check for any outstanding lodgements and reconciling items. So if you don't know what a outstanding lodgement is, all that is when a client has received a check from a customer or a receipt from a customer and it's not yet cleared the bank. Whereas a check from the client going out might be a reconciling item because they have that shown in their bank nominal, but it's not actually cleared the bank yet. So they're showing their bank balance in the nominal ledger as being less than what's in the bank because it's not yet cleared the bank, for instance. Now, in order to make sure that the bank reconciliation is validated, you might in some circumstances go ahead and reperform the bank reconciliation. And where we have any outstanding lodgements or checks, I would go ahead and I would obtain backup information from the client regarding those checks, so maybe a checkbook or maybe a confirmation of a receipt from a customer, or I might go ahead and check post year-end bank statements to see if on the day after the year-end those lodgements or checks have actually cleared the bank, and that would be enough sufficient evidence to show that those items are reconciling items at the year-end. Now, in terms of internal controls and testing controls, you might go ahead and ensure that the bank reconciliation has been prepared by an individual and then that's then been reviewed by a senior. So you've got that additional comfort that that bank reconciliation has been prepared correctly. Now, when you're dealing with cash, sometimes a client may have a petty cash tin, sometimes they won't, and sometimes they won't deal with cash at all, and sometimes they might have a lot of cash, depending on their industry. So when you're looking at cash, it's the same principles as when you're dealing with the bank. So they might have petty cash vouchers, and they might have, like I said before, a petty cash tin, where they keep £100 float every month, so they keep £100 in that cash tin that they top up at the end of every month. And when I say top up, they might have spent £30 in that given month, so they will then put £30 into this petty cash tin to top it back up again to 100. So the same principles apply. So you would go ahead and obtain a petty cash reconciliation if there is one. You would go ahead and check any expenses or income to petty cash vouchers, and there might be receipts behind that you can also check. So again, this third party evidence that you've got. The other thing that you can do is check that, again, the petty cash reconciliation has been performed by somebody who is capable of performing that and has been reviewed by a manager. So all of these sort of things are sufficient, suitable procedures to gather evidence under bank and cash. Okay, so moving on swiftly to non-current assets. Now, when you're undertaking verification procedures, when looking at non-current assets, so tangible non-current assets, they're designed to support financial statements assertions of completeness, ownership, valuation, existence, and classification. So the types of tests that you're undertaking are directed at making sure that those procedures and assertions are being supported. When an auditor gets on site, the first thing they're going to be wanting to do is to check the existence of an asset. So at year end, they might say be at a client's premises to go ahead and check that the individual assets that they've listed on the balance sheet actually exist. So they will go around and check that, for instance, where land and buildings are noted as a balance sheet item, that they actually exist. So where a client has said that they've got a vehicle that belongs to the company, that auditor will go ahead and check that that vehicle is actually there. Or similarly, if a client has said that they own land and buildings, they will go ahead and physically verify those land and buildings. And there's a few reasons for that. So when you're verifying land and buildings, you're not just checking that they physically exist, you're not just checking the existence existence of that, you are also checking for any damage to those buildings, so any impairment of any kind, any impairment to that particular vehicle. So whether when you're looking at valuation later down the line, you're checking if that vehicle has been valued correctly, or if in actual fact when they're saying we can sell this vehicle for £5,000 at the end of its useful life, well, when you take a look at it and it's battered and bruised and needs, new wheels or whatever it needs doing to it, that actually it's only worth £1,000, then you're picking up there and then that that particular asset has not been valued correctly in the financial statements. Now, in terms of existence testing as well, when we're looking at assets that the client has said they have disposed of, then we're going to make sure that they are no longer listed on the client's fixed asset register. So you'll go to the fixed asset register and physically check that that is no longer there. And when you are out there on site, you will check that that vehicle, building, machinery, whatever it might be, no longer exists on the client's premises. And if it does, then you've got to know that, and there might be further testing required, or there might be a reason for that. So in terms of existence testing, you're not going to check everything. You're going to check items that are material in nature, and possibly a sample of assets from the asset register. You will physically trace them to the asset, and vice versa. You'll physically look at an asset on site and check that back to the fixed asset register. So you're doing it both ways for completeness testing. You will also go ahead and have a look at the client's repairs nominal or any other nominal where there might be assets in there that the client hasn't stripped out and put onto their balance sheet. So that again is completeness testing, so making sure there are no assets that have not been accounted for. You'll then check for disclosure, so ensuring that the cost, accumulated depreciation and net book value totals in a fixed asset register agree, and that when you're looking into the financial statements that they have been disclosed correctly. So for instance, the accumulated depreciation hasn't been labelled as cost or disposals or something else. And you would also check in terms of disclosure that the accounting policy that the client has put into place, for instance, straight line method or reducing balance method, that first off, they've noted that in the financial statements, so they've clearly said it's straight line or it's the reducing balance method. And when you look at the fixed asset register, you are checking for accuracy again and for disclosure that actual depreciation method has been put into place. So you're going to have an issue if they've labelled in their accounts that they're using the straight line method, and then when you're looking at the actual fixed asset register, that they're using the reducing balance method. Now, in terms of accuracy, when you're looking at the fixed asset register, you're going to make sure that they've calculated depreciation correctly. So where they've said, for instance, that they calculate depreciation monthly, or they calculate it based on the number of days since the asset was purchased. So you're going to perform spot checks on a few transactions where depreciation has been calculated to ensure that the client has correctly calculated that depreciation. You're also going to check where there's been any disposals in the year and the client has stated that there is a profit or loss on disposal, that has been correctly calculated. So again, you'll check that back to the likes of a sales invoice for the total that the customer has been billed. You'll check the amount that's come through the bank to make sure that the amount in the bank reconciles back to what they've said they've received for that asset. And then you'll go back to the asset register, check the carrying value of that asset, and you will physically calculate if there has been a profit and loss. And then you would check the profit and loss account in the nominal ledger to see if that is actually a profit or a loss, and if the total there agrees back to what the client has said. And another test in terms of accuracy that you can undertake is where the client has purchased an asset in the year and that's gone out of the bank, you can make sure that the amount of costs that they have included on their asset register agrees back to the amount that they've paid, or where there are only certain items that can be included in the cost of an asset, that all of those have been included, or that the cost has been calculated correctly. So I hope you found this first video on suitable procedures to gather audit evidence of use to you. Please consider subscribing as always, and I shall see you on the next video.